This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson iVest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris with Nelson Financial Planning, and for the next hour here on News Radio 93.1 WFLA, also simulcasting on 540 AM. We don't want to forget our AM listeners as well. Dollars and Cents, Central Florida's longest-running radio program. We are, in fact, here to talk about anything and everything to do with your dollars, helping you make sense out of all of those different decisions that have anything and everything to do with the almighty dollar. And when you stop and think about it, it's a pretty wide range of topics that we've covered in the over 1,600 shows that we have done. Boy, I'll tell you what, when you do the math on that, that's a whole lot of shows now, isn't it? I have not done all 1,600 of them. A bunch of them were done by my now late father-in-law, Jack Nelson, and then there were a bunch where he and I did them together, and then there's also been a bunch where I just do them. And about the only thing that has changed is that now the radio show actually doubles as a podcast. That's about it. The same topics, the same analysis, the same things certainly apply when it comes to making sense out of those decisions that have anything to do with your dollars. What makes sense, and should I refinance? How do I educate my kids? How do I retire? All of that, basic human nature in terms of what we want as human beings, when you stop and think about it, really hasn't changed. Really hasn't changed much over the years. So the fundamentals and the core principles certainly have not. Now some things have. Technology, right? I mean, we are now do the show as a podcast as well on the various social media outlets. That's different. Didn't have that 30-odd years ago. But that is more representative of our actually what turned out to be our topic at our client meeting this past week. If you're a client of Nelson Financial Planning, you know that we hold a series of educational events during the course of the year, usually about one a quarter. They're usually dinner sessions that are at the Country Club of Orlando, and we bring in speakers from the industry to talk about various things. Maybe it's tax changes, maybe it's sort of an economic outlook for the year, or in the case of this past week, it was a conversation about business disruptors. And that is the cycle that has propelled this country to the economic powerhouse that it is. And stop and think about how unique it is, where because of how this country is set up, businesses are free to make decisions. Businesses are not told by the government, you must continue to hire people when it doesn't make sense to continue to hire people. Businesses are not told by the government, well, you must continue to make this product or provide this service because people want it right now, and because then that means that you wind up reducing the possibility of change. It is not a government-mandated system, thankfully so. And I think that system often doesn't get much credit out there for what the credit is that it is due, because that really is just a tremendous driver, not just economically, but for what we now have versus what we had 30, 40, 50 years ago. And so the conversation on Wednesday night with our clients was one that was about sort of how that business disruption plays out, right? I mean, the car replaced the horse and buggy, okay? Uber and Lyft are rapidly in the process of replacing the traditional taxi cab. Those are changes that are business disruptors that without a system like we have here in the U.S. probably doesn't happen, or doesn't happen for a long time, because the government would then come in and support the taxi cab industry, because the taxi cab industry was the one that was there. And so with government involvement that supports industries that are in existence, then there's no room for change. There's no room for advancement. There's no room for turning the tables upside down. And when you stop and think about kind of what has driven our economy, it is predicated upon that constructive, destructive process that replaces the horse and buggy with the car, that replaces the taxi cab with Uber, that replaces all of those many different things that we do on a regular basis, that fundamentally changes how we function. The cell phone replaces the telegram. I mean, the list goes on and on and on. And so last week, we did not get to this, but the topic that we were going to actually kind of integrates well with the topic that we had this past week. And so we teased it, but we did not get to it. And that's this notion of smart devices and I guess as an offshoot, the concept of artificial intelligence. And it's funny that actually came up in the presentation and actually in the question and answer period after about artificial intelligence. And many people think it's, the artificial intelligence is, kind of the scary Terminator movie type thing. But you see that more and more with technology. And the simplest example, and we gave this example during the course of the question and answer session, if you've gotten a new thermostat lately in your house, that new thermostat, and in particular in my case, it's a Nest thermostat. And what that Nest thermostat is effectively a learning thermostat. And so that's a lot of this talk of what artificial intelligence is it takes your pattern of behavior and then learns it and learns from that, and then allows the temperature of your house to be controlled up or down based upon what your behavior is. So, in our house, the bedrooms are all upstairs. That has a separate AC unit. I mean, we're not sleeping in the middle of the day because we're at work. And so that thermostat then has learned that, we like to put the thermostat up during the day so that the upstairs is a little bit warmer because there's nobody up there. That's the kind of artificial intelligence that we see on a much greater level now than ever we used to. The refrigerator technology, even a simple refrigerator, right? Where they've got these refrigerators that alert you to when you're running out of eggs, because as you put your groceries in the refrigerator, you basically scan them, and then the refrigerator keeps track of what you've got, the quantity, but also the freshness as well. So just there are more ways where artificial intelligence is becoming more and more a part of the conversation. And these smart speakers are just one example where you've seen exponential growth over a very short period of time. Today, 1 in 6 Americans now own a smart speaker, which is up 128% from January of a year ago. So, and obviously the smart speakers are the Siris, the Alexas, the Google Assistants. All of that is part of that technology. And what's fascinating about that, and clearly there are some issues there that folks have raised about, how much is it really listening to it? How much is it, how much is my privacy at risk? And certainly those are worthwhile issues to talk about in terms of how that technology improves. As with anything, there's always sort of a learning curve of how that integrates into our expectations of society. And so clearly they need to work through that. But if you look at that digital voice assistant and how that works and how much more efficient and effective that makes our lives, ranging from just finding out what the weather is to calling somebody, and you look at that technology in cars and being able to speak a search into your Google Assistant, and even oftentimes I will speak emails into my phone to respond to folks. That technology is the very core of this sort of constructive destruction that happens across the board. So it was kind of a fascinating conversation about that and the implications that's going to have for us and for the markets and for the economy. Talking about massive changes in terms of where the jobs are going to be, massive changes in efficiencies, and even in places where you wouldn't necessarily think about it. I mean, the amount of focus that's being put on that. Amazon alone, for example, 12,000 engineers working just on the voice and innovation part. I mean, stop and think about, how much is being focused on this as sort of that next wave of constructive destruction starts to ripple through these voice assisted technologies. Even seeing it in places where you wouldn't necessarily expect to see it. Senior housing, for example, is having more of those devices as ways to help adults in their facilities, where they're waking them up, talking to them, making sure that they are whether they need any assistance or not. So just another great example of that kind of constructive destructive process that is occurring throughout, and a fundamental backbone of our American economy. And frankly, one of the reasons why we think it's as successful as it is that process that's allowed to take place that ultimately promotes and provides a tremendous amount of advancement. We are also, during the course of the meeting this past week, we did a little political talk, which was more at my court. And so I want to share with you what our comments were on the political side of things and what the economic in-market impacts are on that. So we will do that, but we're going to do that after this break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. You're listening to News Radio 93.1 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris here on bright and early on a Sunday morning. This segment of the program, we're going to talk a little bit about some politics. As we were talking earlier in the program, we had a client meeting where we brought in a speaker and talked a little bit about that cycle of business disruption, which, in our opinion, is one of the biggest reasons why our country's economy is where it is in the rest of versus the rest of the world. That constructive-destructive process is a process that we see. Fortunately, the government doesn't get too involved in that, and that's a good thing. That's probably why we're not a big fan of government involvement in the first place, because it's in the absence of that ultimately drives the innovation that ultimately puts certain businesses out of business as new products or new innovations come online. And certainly we see that play out each and every day. And if you take a step back and look over the course of a number of years, you'll certainly see that see those changes occur. If you look at what we have now versus what we did or what we were using 30 years ago, it's really pretty tremendous. But a lot of things do stay the same, and many of which are kind of the over-fixation on politics, particularly in a midterm year. And so we thought we would give you some takeaways, if you will, based upon prior midterm years, because we are, we're 6-7 weeks away from midterm elections. So that is coming right up, to say the least. And so if you look at the midterm elections and look over the past 85 years, there are some patterns that you can recognize that we'll share with you here this morning. Number one, the president's party in power typically loses seats in Congress. Okay, and when you stop and think about this, it should make sense to you. Why? Because the opposing party, the party not in power, would have just lost the prior election. So what happens when you lose the previous election? Well, you turn into being a bit more motivated for the current election. And so what happens is the party out of power generally shows up a little bit stronger than the party in power. Understandable. That's just basic human nature. So as a result of that, if you look at sort of the average numbers, on average, the party in power, looking at the past 21 midterms, the president party in power loses an average of 30 seats in the House and an average of 4 seats in the Senate. So don't be surprised when that happens this fall. I don't know that the shift in the numbers are going to be that dramatic, but just understand how that relates to the average. The average is 30 seats in the House. The average is 4 seats in the Senate. So anything better than that would be an above average result for the party in power, at least from the presidential perspective. The other issue is the markets. Now, the markets in midterm years have a tendency to move sideways for most of the year, gaining very little until such time as the election happens. And that's sort of, if you stop and think about this year, that's sort of the pattern that we have seen play out so far. Another issue with midterm years is that typically you will see a little bit of an uptick in volatility, particularly as those elections get closer. So stay tuned on that one over the course of the next few weeks. It does also coincide with third quarter corporate earnings. So those also could have an impact on that volatility factor as well. So, but usually you'll see a little bit of a run up in volatility, particularly if you kind of look at things like standard deviation. You know, some market concepts suggest that there's a little bit of an uptick in volatility. So to recap, party in power loses a bunch of seats. 30 on average in the House. If you look at over the past 85 years of midterm elections, 30 in the House, 4 in the Senate. The market usually trends sideways. Volatility kicks up prior to the elections. But the last point we want to make, which is probably the most important, is that once you get that resolution, of the election, well, then guess what? Well, the market responds relatively positively because if you think about it, you then start that third year of the presidential term. And when you look at market returns during presidential terms, the third year is usually the strongest. The president has, the president has his legs underneath him. There's more to that, but the reality is that third year historically is the strongest year in terms of the market during the course of the presidential term cycle. So once you get through the midterms, you get that resolution. The returns are above average for the typical versus the typical trend line for the full year after the election cycle. So here's the actual number. Since 1950, the average one-year return following a midterm election is 15%, more than double that of all of the years during a similar period. So pretty strong numbers once you get resolution on the midterm election. So stay tuned on that as that plays out. One other comment that I did make, which we've mentioned before on the radio program, but we'll mention again since we're kind of talking a little politics. You hear a lot about impeachment, and frankly, if I had most of my former business associates flipping on me, I'd probably be worried about that as well. But the good news is that if you look at the last impeachment, impeachment trial, which was of course Bill Clinton, many people think that the market just, gets so fixated and so worried and just can't get over itself. No, the market doesn't. The media will. Okay, so you're going to hear a lot of smoke, mirrors, and excitement out of the mainstream media. Meanwhile, the market isn't really going to get too terribly excited about that one way or the other. And the reason we say that is you simply go back to the last time it happened. It was Bill Clinton. And you know what the market did in the 12 months leading up to his actual impeachment trial? It was up 25%. So don't get too hung up on, I'm concerned about politics. I think I need to change and go dramatically more conservative. And I'm just not going to invest now because all of this is on the horizon. Well, be careful, okay? Because as we constantly have said on this program, it is time in, not timing, of your investments that leads to long-term investment results. So don't get too hung up on this, just as with anything else. Don't get too hung up on it. But those are certainly some interesting numbers and some interesting perspective on the elections and kind of how all of that plays out. We'll slide to the break. During the break, we'll open up the lines, 407-916-5400. Toll free, 866-916-5400. And then if you want to send us an email, Joel, Joel, at NelsonFinancialPlanning.com. So we'll check the email during the break, and we'll take your call. We're always excited to add more topics to the radio program each and every Sunday. So give us a ring if you'd like us to talk about your topic or send us an email. We'll be back after these messages here on Dollars and Cents with Joel Garris, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is News Radio 93.1 WFLA. So we checked the email during the break. And Stephen sent us a link to an article on the New York Post and was asking for our comments on it. New York Post article dated, is that today, September 22nd? No, that was yesterday. Entitled, Next crash will be worse than the Great Depression, experts. So I guess there's, okay. So this is where I say if I had a nickel for every one of these stories, I'd have a whole lot of nickels. So if we scroll through the article, let me come down to who it is that's saying. So it's not experts. It's basically one expert, if I'm reading it closely. A guy by the name of Peter Schiff. Okay. We won't be able to call it a recession. It's going to be worse than the Great Depression. Okay. U.S. economy is in so much worse shape than it was a decade ago. And then, interestingly, the article does say, although Schiff has gotten some calls wrong in the past, I'm guessing that he has. He incorrectly predicted that U.S. Federal Reserve would fail in its roundabout quantitative easing campaign to reflate housing and stock. He is convinced he is right on the money this time. Okay, and then compares the U.S. dollar to the Turkish lira. Where do I begin on this? So U.S. dollar is not like the Turkish lira. The lira, very unknown currency. The U.S. dollar is basically the depth and the breadth of the U.S. dollar, I think, is something that people don't quite understand or comprehend, which is why it is the standard that things are priced in, like, oil, because of the liquidity of the U.S. dollar market. And that liquidity comes from just how broad and how deep that market is in U.S. dollars. That's why unlikely that you will see the U.S. dollar replaced in our lifetime as that standard, because it is so much larger than anything that possibly comes close. So the euro isn't even in the ballpark. The Chinese yuan certainly is not, combined with the fact that it's sort of manufactured in terms of its value because it's controlled by the government, and free enterprise doesn't really like that, and certainly world trade and economics also don't like that. What's interesting about these articles, and there's a slew of them out there, and you go online, you can find them in a heartbeat, is that they do ignore a lot of the realities that do play out after a major decline. And let's call 2008 what it was. I mean, it was a major decline. Absent the Federal Reserve doing its TARP plan and bailing banks out, which the same guy in this New York Post article is saying, well, I didn't think they were going to be able to do that. It was just going to continue to crater. So we got that one wrong. Absent that, and the ability of that to work, then who knows how it all would have turned out. The reality is, though, that 2008 in its own right, certainly a pretty dramatic year. And the reason that we say that is not just because of the quantity of the decline in the markets during that year, and it was about 40%, but rather the lasting effect. And about 2-3 weeks ago, we actually talked a lot about this on the radio program. And one of the biggest reasons why you're seeing these articles as much as they are is it's sort of the 10-year anniversary of the Lehman collapse. That's sort of what's been going on. What was going on this month 10 years ago is Lehman collapsed, and then the markets really sort of accelerated. That loss in 2008 really accelerated starting about mid-September, running through about mid-November. Really got lit with some lighter fluid in the first week of October, when the government did not, Congress actually voted down that TARP program on the Monday, only to kind of bring it back around and vote it up on the Friday. So that was kind of the lighter fluid, if you will, for that decline, particularly in those 60 days in 2008. But the lasting impact of that, I think, is largely ignored. And we talked a little bit about it 2-3 weeks ago here on the program. If you look at the risk appetite, is very different than what it was going into 2008. So 2008, dramatic certainly because of its decline and the percentage decline. But then you have to look after that and say, okay, well, then how much did people's perspective or people's behavior actually change? And the answer is quite significant when you continue to look at the statistics today. If you look at what the numbers were going into 2008, 30% of all American households own stocks or stock mutual funds. Today, that number only at 24%. How much higher is the market today than where it was at the peak prior to 2008? It's about double. So you stop and think about that risk and that appetite for risk, just how much that still weighs on people's investment decisions. That, to me, is a much greater indicator of how long it will be before the next dramatic downturn occurs, because you just don't have that buildup in risk across the board like you did going into a 2008. Similarly, if you look at lending, I mean, we all know it's much harder to get a mortgage today. Your average credit score has to be higher. Generally, you're being asked for a larger down payment in order to get a mortgage for a house. The amount of home building at this point in the cycle, you should be expecting about 1.5 million homes being built. The reality is that it's only at 1 million. So that's still, even though we see a lot of home building, it's still at a much lower threshold relative to where you would typically see that. Businesses, corporations, using cash much more than using debt. So I think the underlying buildup that you would typically see that does cause significant economic problems is just not there on the consumer or the corporate side like it is in the past. Now, certainly you can say, well, wait a minute, that's not really the case for governments worldwide, and that's the point of the article in the New York Post, is governments worldwide have built up a tremendous amount of debt, and that is certainly very true, to try and support a higher economic or a better economic recovery. And I think one of the important things is to always look at that relative to global economic output. And relative to global economic output, that debt really isn't a whole lot different percentage-wise as it consistently is throughout history. So certainly not wrong to be worried about debt, because certainly that's nothing that we would encourage an individual to do, is to take on a bunch of debt. But I think government debt and how that actually kind of plays out, you always have to look at that relative to the overall economy. And if you just look at those numbers in isolation, then then that sort of ignores where we are in a cumulative economic perspective. So you'll see a lot of them. That's one of the biggest reasons why you're getting a lot of these articles these days, is because it is 10 years post-2008, particularly the worst part of 2008. But I would encourage, Stephen, you to read the sports section, or maybe the travel and leisure section, or the cooking session, or the restaurant review section of the paper, and try and stay clear of the fear-mongering part of the paper. Of course, the fear-mongering part is on the front page because they want to make sure that they're selling newspapers. But thank you for forwarding that article, giving us an opportunity to comment on it. We're going to slide to the break. When we get back from the break, I want to recap the week that was, and then also share with you a fabulous and exciting email that I got in my inbox the other day. So stay tuned for that here on Dollars and Cents. This is Joel Garris, News Radio 93.1 WFLA.
Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, Dollars and Cents, here on News Radio 93.1 WFLA. Got to get to this one, okay? Boy, I'll tell you. And obviously at the office we have a lot of security and filters for our emails to try and ferret out the junk and all of that nonsense hitting the inbox. And usually it does a pretty good job, and so it doesn't kind of fill up our inbox with a bunch of nonsense. But every now and then something slips past, and that's because a lot of these emails are being, not a lot of these, all of these emails, like the one that I just got this past week, are in fact being sent by criminal enterprises, whether it's here at home, usually not. Usually it's Russian or Chinese or Korean that are intentionally trying to trick you into doing something that is going to cause economic harm to you, and they're effective in terms of trying to trick you, because they try and make it look like that it is in fact legitimate by referencing something that is legitimate, by something that would catch our attention. So this email comes to me courtesy of the FBI. So I mean, that's, that would catch it. And it's telling me that I won $1.5 million US. Congratulations. And it references my email address, actually using the old email address. That's the first thing that kind of caught my eye. You won the sum of $1,500,000 via Mega Millions International LLC. Click here to claim now. What do you think happens if I click there? Do you think that's going to be a good thing? You think all of a sudden, magically, I'm going to have $1.5 million transferred into my bank account? Or is there going to be some nasty virus that then comes on and messes up my computer system? Or worse yet, there's some, ransomware thing that pops up on my computer. Look, folks, I mean, this is the world we live in, where technology makes it easy for those types of things to happen. Be very careful with that. Do not fall prey to that. If you see anything like this, don't click on it, exit out of it, and delete the email. Don't click on anything inside of that email, because at the end of the day, it will bring you harm. It's funny. We have a IT guy at the office, and so it is frustrating, because we do send out, when we send stuff out, particularly client-related information, we always have to encrypt it. Well, the encryption is not easy to unencrypt for the recipient. We actually have like a YouTube video that my IT guy did to explain like how to open up the encrypted email, because it's not easy. And so every time I'm like, well, talk to my IT guy, and every time I'm like, well, can't we do something that makes it a little bit easier if I'm the recipient of this thing to open it up and so it's not quite so frustrating, so we don't have to direct people to a 3-minute YouTube video to help them walk through how it works. And to which he always responds, security and convenience are not things that go hand in hand. That's probably right. But the reality is, though, that if you get anything like this, do not, but you would be surprised at how many people fall for that stuff. Don't fall for that stuff. It's a criminal enterprise that's after your money. My goodness. Anyway, so last week in the market, good week for the markets. With despite the headlines, right? I mean, we've got all this big conversation about tariffs. Okay, we had another $200 billion in 10% tariffs on Chinese goods, which could rise to 25% tariffs by the end of the year. China retaliates with $60 billion in tariffs at 5 to 10%. And then we threaten back that there'll be another $267 billion subject to tariffs going forward. So clearly that tariff conversation really started to escalate. It's funny, earlier this year, the market would have certainly reacted to that. It's almost like the market has kind of accepted this bombastic conversation that is happening between the U.S. and China as it relates to trade. And I think one of the reasons why the markets have sort of, they're I'm going to say comfortable with it, but they don't overreact to it, is that with all of these conversations, we now are, in fact, starting to actually strike new deals. And the deal with Mexico is a perfect example of that, where, there was a lot of back and forth and hard bombastic conversation on both sides of the aisle, but yet there was an agreement actually achieved, and I think the market sort of is interpreting or reading kind of these back and forth conversations with a bit more knowledge than what it had earlier in the year. When every time this conversation happened, it seemed like the market sort of reacted negatively. I think the market has now sort of gotten to the point where, wait a minute, based upon how this has played out with other countries, we do in fact strike deals. When we get to the point where we want to strike a deal. So against that backdrop of tariffs, and then of course you also had the political of the Supreme Court nominee and the allegations and from this woman and my goodness, that is just catching a tremendous amount of attention these days. But of those, economically, who's on the Supreme Court doesn't necessarily drive the economy. It's really more the conversation about the tariffs. The tariffs really have a big, potentially a much bigger economic impact, but the market seems to be kind of dealing with that conversation, and ultimately the markets actually had a pretty good year with hitting new highs on Thursday. The Dow for the week was up almost 600 points, and so the week that was actually a pretty decent one. Looking ahead to this week, you've got a Fed meeting on Wednesday, widely expected to hike interest rates up 0.25 point. So keep an eye on that. That's probably the biggest headline up ahead as we look at the week ahead. So stay tuned on that. Guess what? We'll be back next week to talk more about that and whatever else happened during the course of this coming week. So stay tuned for that. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning here on News Radio 93.1.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.